Hello, and welcome to the 2019 Annual Board Presentation. We are excited to share our results with you and how we plan to exit our 3 positions. We have a few new board members, so we're going to give a quick recap of our humble beginnings here at Altuve Resources. Then I'll give a brief overview of my management team. My team will then discuss our past results, recent transactions, and ultimately why we believe now is the right time to sell our assets and individual pieces. In 1982, Pablo Altuve, father of now famous Jose Altuve, opened up a coffee bean export business in Caracas. His wife, Maria, was a petroleum engineer and never quite understood her husband's obsession with coffee. Together they raised 5 boys: Luis, Alejandro, Angel, Jesus, and Jose. Despite being the shortest of all of his brothers, Jose was by far the best baseball player. Jose decided to move to America to pursue his dream of playing in the majors. Jose's brothers followed Jose to America to pursue their own careers in oil and gas. After Jose won a World Series and cashed out his Bitcoin investments, he decided to give his brothers a fresh start by giving them a $300 million equity commitment to start up their own E&P company. Altuve's team consists of myself, Angel, as CEO, Jesus as CFO, Alejandro as VP of Exploration, and Luis as Risk Manager. Now I'll pass it off to Alejandro to discuss how we decided to allocate our $300 million.
Thank you, Angel. Prior to making any capital investment decision, we first performed detailed well economics in all of the basins in which we had an acreage position. At time zero, the exploration team determined that the Marcellus provided the best economics, followed by the Woodford and lastly the Haynesville. Both the Woodford and Haynesville locations were largely dependent on $4 gas prices, whereas the Marcellus was economical even at $3 gas prices. None of the basins were economical in a $2 gas price environment. As a result, the Marcellus acreage was important to develop early in order to get low-cost production online quickly and accelerate cash flows. In the event of lower gas prices, we wanted to drill our best acreage first to continue generating free cash flow even in a more challenging environment. The VP of Exploration and Risk Manager discussed the unpredictable cost environment and decided that basin diversification was paramount in early development to avoid any concentration risk. Our basin diversification strategy was designed to insulate Altuve Resources from negative changes in cost structure, namely basis differentials and D&C costs. This proved to be beneficial in future years as both basis differentials and drilling and completion costs remained volatile. As a result of this analysis, the Altuve team began the development of its Marcellus, Woodford, and Haynesville initially in 2019. As Angel alluded to, we made the decision to allocate our capital evenly amongst all 3 basins. We opted to allocate about 85% of our capital in 2019 for CapEx in order to preserve about $50 million in additional liquidity. In the lower price environment of 2020, we cut our rig activity back to 2 in the Marcellus and 2 in the Woodford. We did not have any rigs running in the Haynesville at this time due to high D&C costs in addition to a negative 40% basis differential in the Haynesville. We were able to successfully operate during this period, and as the price environment proved more favorable in 2021, our ability to high-grade our drilling inventory and efficiently operate allowed us to be well-positioned for the next stage in Altuve's growth story. In 2021, natural gas prices moved up to $5.50, significantly improving cash flow and unlocking newfound value in the Woodford and Haynesville basins. In 2021, D&C costs declined as new rigs were relocated from Canada to the United States, improving overall economics, especially in the Haynesville. Our rig count increased significantly, as you can see in the bottom left-hand chart. The Haynesville love was short-lived, however, and in 2022, Haynesville D&C costs skyrocketed to $10 million, as seen in the top right chart, and differentials moved back to negative 30% versus Henry Hub. This had a minimal impact to Altuve Resources, however, after a transformative transaction that Luis will cover next. The chart on the bottom right provides single-well PV10 economics across all basins over the last 4 years. As you can clearly see, the Marcellus and Woodford have provided the best economics, and both basins have been the priority within Altuve Resources. And with that, I'll turn it over to Luis to discuss the asset swap and hedging strategy of 2021 and 2022.
After a successful first year of drilling, we had the option to turn to the debt capital markets to add additional funding sources. We had the option of either a $100 million RBL loan or a $500 million mezzanine loan. Now, with the type wells yielding well over 80% IRR, we modeled the RBL debt to be the most accretive out of the 2. To further validate our decision, we stress tested the downside case to $2 per MCF to ensure the base production would cover the debt payments to limit the risk of default. While the size of the mezzanine loan was more attractive if gas price were to increase substantially, the higher interest rate, the 5% MPI, and the fact that RBL had more downside protection than the mezzanine were all reasons we opted to take out the RBL. Although we are always searching for accretive A&D opportunities, it wasn't until 2021 that an attractive offer came along. At this time, Altuve Resources and El Tiempo came to an agreement on a nearly one-for-one asset swap. In exchange for divesting 18,240 Haynesville acres, Altuve received 17,280 Woodford acres. The economics on an NPV basis were immediately accretive to Altuve in the amount of $96 million at 2021 gas prices. In addition to our VP of Exploration loving the asset level economics, our management team was able to realize cost synergies through the Haynesville staff consolidation. In the end, we redistributed our asset base to focus on two most profitable basins. In 2021, in addition to our asset swap, we took the opportunity to lock in gas prices at $5.50. We made the decision to go ahead and hedge 100% of our Marcellus production due to the higher perceived regional risk, but made the decision to step down our hedge volumes on the other two basins to 80% for 2023 onward. The decision to step down hedges in the Haynesville and Woodford was due to the desire to decrease volatility and commodity price exposure while still preserving 20% of volumes for upside potential. Although we missed out on $240 million in 2022 due to this hedging, we would have lost an additional $20 million had we not kept this 20% unhedged. Despite the short-term opportunity cost, our risk department and investor base find this strategy worthwhile due to the downside protection. With commodity prices at the highest point in over a decade, our team evaluated our remaining inventory in early 2022. We decided to finish drilling our remaining Woodford wells and to save our less economic Haynesville PUDs for our divestment packages. Our current forecast calls for peak production to reach roughly 700 million a day by the end of 2022, holding a good production wedge out past 2028, at which point our estimated rates will still exceed 220 million a day. Our combined portfolio of assets became self-funding on an annual basis in 2021, and we anticipate we'll spending off over $1 billion annually by the end of this year. Although we will show you commodity price sensitivities later, you can see that the full projected life levered PV10 of over $3 billion and an IRR of 108%. Now I'll pass it off to Jesus to discuss our recommended exit plan.
Thanks, Luis. As most of you are aware, last year's gas prices averaged about $6.50 an M, much higher than expected, and based on our marketing group's projected strip, we believe prices are more likely to average closer to $5 going forward, with an 80% confidence interval between $4 and $6.50. Based on this outlook, we believe that selling while prices are high will help maximize our returns to our investors. Overall, we've evaluated 4 different options. First, an IPO, but based on feedback from our sell-side analyst, we do not believe that the market will be receptive to PDP gas assets at this time. Second, continuing to operate the assets and producing them down, but given that we have limited acreage left for development, we believe that these assets are more appropriately earmarked for yield investors, and given our high cost equity backing, this would not be an attractive option long term. Finally, we've looked at divesting of these assets as a whole, and upon further review, believe that we can realize a higher return if we split the assets out by basin and sell them individually. Our 2 focus areas for marketing will be yieldco vehicles and in-basin strategics. Since the majority of our assets are PDP and significantly hedged, we feel that they are primed for delivering safe, predictable distributions that will be necessary for yieldco investors. Alternatively, we will also market these assets directly to pure-play strategics that are looking to bolt on existing assets in an effort to lower costs through scale and extend their acreage position for future development. In an effort to get approval to move forward with the asset sales, we've consulted with our advisors and feel confident that we can expect between a PV10 and a PV12 for our PDP assets and around a PV20 for our PUDs in the Haynesville given the current market environment. These valuations would yield expected proceeds of $731 million to $1.2 billion for the Marcellus, $1.8 to $3 billion for the Woodford, and $347 to $389 million for the Haynesville. Combined, expected sale proceeds would be between $2.9 and $4.6 billion, and after unwinding hedges of approximately $600 million, we believe this would still leave a very attractive exit for our investors. In summary, our return numbers speak for themselves. We've taken our initial $300 million equity investment and returned just over $1.6 billion in free cash to date, with a remaining net asset value of around $3.5 billion. This amounts to just over 100% IRR,
or 17 times return on capital in less than 5 years. Now I'll turn it back over to Angel for closing remarks.
You can see from the results that this time the other Altuves are the ones that hit the grand slam. With the current price environment and little running room remaining, we firmly believe that this is the ideal time to slide into home. We strongly recommend that the board gives us a sign to bring in the closer to sell these 3 assets individually. Thank you for your time, and we will now open up to any questions.